obviously you guys can read. So, and then we'll go through, I'll list out some FAQs and other links and resources that might be helpful to you guys as well. Most importantly, the CPE code is 780. We're not going to skip the codes, don't worry, 780. Really quick disclaimer, these are my views, is basically what this comes down to, right? I don't speak, obviously, I'm a member of the FINRA staff, but they are my views and my views only. So any subjective commentary I give, are not the views of FINRA. All right, so it's the hot topics. So the first hot topic, and this has been a hot topic for a couple of years now, but there's been some movement on it semi-recently that I think is interesting, is related to Staff Accounting Bulletin 121. And that is related to the accounting for obligations to safeguard crypto assets an entity holds for platform users. So just for those in the room, just to show of hands, who audits clearing firms, clearing or carrying firms? Anybody? Okay. So mostly, well, all non-clearing and carrying firms. So this topic is actually still relevant, to be honest with you, because it sounds like, well, if you're not custodying these crypto assets or these digital assets, then you don't have to worry about it, right? What's been interesting about this issue is that it's capturing firms that are not actually carrying or clearing these types of assets. Actually, just to give you an idea of scope, we only have one broker-dealer that's considered a special purpose broker-dealer. There's a special SEC order where if you basically you fit between certain guardrails, you can actually custody digital asset securities, right? We only have one firm approved to do that, and I don't think they're active yet. So, and this is not an issue for them currently. So, but this is still a big issue, and it's not just broker-dealers, it's banks, it's everyone out there, right? So anyone that the SEC would have jurisdiction over, but it's had interesting implications for broker-dealers. So what happens with the accounting, just in a nutshell, is that if you are in the scope of this accounting, you have a safeguarding liability, right? So you have this obligation to protect what I'll call the customer crypto assets. And there is a corresponding gross, what they call an indemnification-like asset. And, obviously everyone here is at least fairly familiar with broker-dealers. If a broker-dealer is custodying customer assets, you don't put those customer assets on the balance sheet, right? That's off balance sheet. They're not your assets. There's no liability on the books for safeguarding it. So just in terms of the principles, it's a conflicting principle, right? In the traditional broker-dealer world, securities don't go on the balance sheet if they're that of the customer. So the gist of the SAB 121 is really that they feel like this is, and again, this is my kind of analysis to digest this for you a little bit, right? But this is such a big risk in the eyes of the SEC staff from a technology, legal, and regulatory risk perspective that they feel like it needs to be right on the balance sheet from like a disclosure perspective, not buried in the footnote disclosures. They want it right on the balance sheet, kind of staring you in the face, right? And I think that was that's kind of the intent there. So now what's happened, right? From a FINRA perspective, we don't take a position on accounting. And I know some of you are thinking, well, you just put a reg notice out on revenue recognition. How do you not take a position on accounting? I'll talk about that in a few minutes. But from a SAB 121 perspective, everything with net capital, well, and I'll stick with net capital for now, starts with US GAAP, right? It starts with equity, it starts with your net worth, and you adjust from there, right? In terms of getting to a point of some sort of liquid capital or liquid assets that you would have in the case of a liquidation. That's kind of the gist of the net capital rule. So when you think about what the balance sheet looks like, if you were custodying 50 million of these crypto assets and you had 50 million assets, 50 million liability, well, just on this, if you stop right there, you have a $50 million non-allowable asset. That's could be quite large, right? And so that's obviously from a net capital perspective, not a great answer. And so firms are saying, well, I don't custody this stuff. Like, why is this a big deal? So what's happening is that there are broker dealers that are part of a family of entities or a consolidated group, and their affiliate may be a crypto entity, right? And that broker dealer, they don't put themselves out as broking crypto assets or anything like that. But in consultations that broker dealers have gone to the office of the chief accountant for to make a determination on this, I'm aware that they've been told that the perception of customers or clients that maybe there isn't enough separation between that broker dealer and that crypto entity. Perhaps you have to, in some cases, you have to open a broker dealer account in order to trade crypto at a different affiliate. And that cash has to be transferred from the broker dealer to the crypto affiliate. Or if you go into an unnamed broker dealer's app and you go to trade securities, you may be able to see your crypto and your securities balances right on that same screen, right? So it creates that perception that that's all the same entity. That's kind of the gist, I think, of what the SEC staff was really trying to focus on, to be quite honest with you. So there, as you can imagine, there has been a significant amount of uncertainty of how to treat this. There are firms that changed their business models because of this impact. There are firms that got out of the business because of this impact. And so what's happened is, and firms have gone to the office of the chief accountant for consultation on an individual basis to say, well, we still don't think we should have to gross this up. We shouldn't have to take this hit. So long story short, there was a lot of uncertainty until this past February. The office of the chief accountant staff, they met with the AICPA broker-dealer expert panel and verbally provided some guidance on facts and circumstances of a firm that did consult with them, where they were able to conclude that they did not need to have what I'll call that SAB 121 gross up on the balance sheet. And so if you go to the AICPA website, if basically you can Google AICPA broker-dealer expert panel meeting minutes. So it's the meeting minutes from February, and they documented these points. And there were 3 high-level points that were in there. I won't go through all the nitty-gritty detail on this, but it was, that you wouldn't have possession of the cryptographic private key or, the password, equivalent of the password, right? That there's persuasive evidence that the agency relationship between a third-party custodian and the customer did not involve the broker-dealer. So that they were, basically saying there's some written agreement that says, I don't have an agreement with you. That essentially is kind of the gist of it, right? And then finally, that the broker-dealer in this case had gotten a legal opinion from external counsel, essentially hitting on all those points I just mentioned, among others that are kind of tangentially related to it. So it's been an interesting run the last few months on this. So now the OCA basically provided this path to, this is how you can be in this business, not be in this business, and kind of drawing kind of a faded line, so to speak, or in pencil, right, of like where you wouldn't want to cross over. So then where does that leave us from a net capital perspective, right? So in March, so FINRA staff spoke with the trading and market staff at the SEC, and they communicated from the SEC that essentially there is verbal guidance for broker dealers that if they're in a position where it looks like they would have to have that SAB 121 asset and liability, however, they're in good faith working towards being in compliance with the OCA's guidance that they discussed with the AICPA, that essentially, and again, I'll stay out of the nitty-gritty detail of it, but that essentially you wouldn't have to take the negative net capital implication of that until you came into compliance with the accounting portion of it. So as you can imagine, I talked about February and March, right? So the timing of that was probably not ideal for firms that were filing in, guess what, February and March. So there were firms that took the capital charge, very large firms that took the capital charge, firms that had to make, an accounting policy decision whether to include it or not. So It's definitely an issue that has a lot of eyes on it as well. I believe it's, it's gone through Congress about whether to strike it down or not, even though it's a staff position. I believe there was a GAO report that said that SAB 121 was, they said that it was a rule. It was really rulemaking and didn't go through the process appropriately. And my understanding is I think there's a bill sitting on the president's desk right now of whether to rescind SAB 121 or not. So it's been an interesting, for an accounting topic, it's made its rounds a little bit. So that's why I kind of tip off with it a little bit. But if you have clients or you have firms that have affiliates that are doing crypto, because we're seeing firms that have affiliates, large, small, medium, doesn't matter what size and what capacity they're getting into it. It's something that I would just read up on, frankly. All right, so it's a more traditional topic. The next hot topic is 15C33 computation proposal. I'll go through this one quickly because I know it won't really capture the firms in this room too much, but essentially we have there's 3,400 broker dealers roughly, and there are 150 broker dealers that do a customer reserve computation under 15C33. And they do that for the most part. That's done weekly. There are some firms that have very limited business, may do it monthly, but for the most part, it's a weekly computation that's done as part of the process. So this rule proposal from the SEC would actually require certain firms over a certain threshold to do a daily computation. So to give you a sense, so of those 150 firms, roughly 60 of those firms, as the proposal is right now, would have to do a computation. And currently right now, voluntarily 11 firms, and obviously it's mostly the larger firms, they voluntarily do the daily computation. So it is being done in practice right now. And I think the main concern there is that, on a Monday, you're going to lock up customer payables or cash for customer payables from the previous Friday. There could be huge swings in what you owe a customer or not during the week, and you're only doing this computation once a week. It creates a liquidity issue. Does a firm have to now put up cash to make people whole if customers want their cash back? The timing of everything can create risk for firms and for customers, frankly. So I think that's really kind of the impetus of everything. Obviously, there'd be a cost of implementation, but this is something that I know there's some industry comments being considered still right now by the SEC staff, but that it's likely in some form to be finalized this year. In terms of coming out as a final rule, and then I'm sure there'll be some rollout for the effectiveness. Next item we have on there is SEC electronic filing proposal. So this one came out in March of 23, and there was a comment period for a couple months. Essentially, what this would require is that if you file an annual report, no matter who you are, or a 17H report, no matter who you are, you have to file via Edgar electronically. There's no more paper filings after this rule goes through. And that's kind of really the main thing that I think they want to get through, is they just want everybody to file electronically. There's an XBRL component to this. So for those of you that audit public companies, you probably are familiar with the pain that your firms go through for this, right? This, as it was proposed, the XBRL requirement would apply regardless of a firm size. And when I say a firm, a broker-dealer firm. So I apologize if I make that confusing at all. I live in the broker-dealer firm world, and I know I'm speaking to an auditor audience, but just if I don't correct myself, if I say firm, I mean broker-dealer firm. But a broker-dealer firm, would have to do that detailed tagging for XBRL. So there are going to be some amendments to the focus reports. They're mostly technical corrections, really nothing that frankly is life-altering. No like new pages or anything like that. It's mostly just adjustments, and the rule would explicitly accept electronic signatures for the focus reports for the firms that are doing that. And for the most part, it'd be 2 signatures for a focus report. But if a firm only had 1 principal, it could just be the 1 principal that does it. That's something else that's likely to be finalized this year as well. I would expect certain aspects of it to have a quicker turnaround. So in terms of Edgar filing, so if this were to get finalized, say in October, I would expect that the SEC could very well say you need to start doing it this year, 12/31/2024. So what I would say is if you have firms in this scenario, I would recommend to them just go get your Edgar credentials now. It's not that bad of a process. You know, worst case scenario, it takes a week for you to get things straight. If you start from now and you don't even worry about it full time. So it's something that once you do it once, it's fine. I came from the firm side before FINRA. I've been at FINRA for 6 years. I did Edgar filing before I was here in CFO capacities at broker dealers. I think it's a good step, frankly. So just something to keep in mind. All right. Now we get to revenue recognition, which I do see some questions in here, some very detailed questions about revenue in here. So, and I will touch on some of the concepts here. So we came out with regulatory notice 2321. I should remember the number because I helped write this thing, but it came out the end of December, and it was a reminder for firms that if you do misapply revenue recognition accounting, ASC 606, that's not just an accounting thing. That could be a capital issue. It could be a books and records issue, 1783 for broker dealers, 1785 issue for financial reporting. It could definitely have a trickle-down effect. So the main impetus why this even was published was because we are seeing, even though ASC 606 is, I think, what, at least 6 years old at this point, that we are seeing a number of firms, especially small firms, and I would go as far as to say M&A advisory boutique type firms that are more thinly capitalized, $10,000 of net capital, but take in large fees, right? Like take in a retainer of say $1 million, right? And or have capital of $10,000. If you don't account for that retainer either partially or in whole correctly, you could be out of the capital really, really quickly. And that's what we were seeing. So we were seeing scenarios where the traditional or a traditional, and obviously every M&A deal is different. You know, there's a success fee, which really is not in dispute in terms of the accounting for that. You know, when you get close to closing a deal or once you close a deal, you would kind of recognize that we see, you know, the revenue getting recognized for that towards the end. However, there's a retainer fee structure. And just to stay with the more straightforward example, we signed an engagement letter with the client today, and they sent us $1 million, a non-refundable retainer fee. Specifically says non-refundable in the agreement, and they record it as revenue on day one, but they haven't done anything yet, right? They just signed the agreement. And so our question is, well, okay, can you show us your ASC 606 analysis? What documentation analysis do you have to support recognizing that as revenue upfront? Because you know, we understand you have to satisfy a performance obligation at a point in time or over time, right? And recognize the revenue accordingly. Now, that's not us taking a position, frankly. That's us just, you know, looking at the firm's policy, the audited disclosure policy, asking for their policy, their documentation, and saying, how does this match up? How is this compliant with ASC 606? And the common answer we were getting was that it's non-refundable. It's in the legal agreement. I legally don't need to pay it back. So hopefully for most of you that's, you know, hitting home that that's not a great answer, right? So, but we saw this happening over and over and over again. It's like, you know what, we really just need to give a heads up to firms. And that's really what this was meant for, give a heads up to firms to really just kind of understand, look, you got to know what ASC 606 is. And you need to document it in a way that is compliant with the standard. And because we can and we will ask about it to the extent that it's going to be material. So hopefully that answers why that is so important and why it's so important for auditors to be aware of that as well. Obviously, it makes a huge difference. So CPE code break. So 601, code 601. I did get a revenue recognition question in here. I just want to make sure I did respond to it. Diligent can be recognized. So we do see firms, so again, not opining on the accounting, right? But there are firms that we see have structures where they get retainers monthly, they get a retainer up front. There's no preferable way, right? Like this is all, whatever the contract is, the contract is. It's just that you have to apply the accounting to what the transactions are, right? So ultimately, yes, we see compliant firms that have shown their analysis and they have monthly retainers and they've shown why that it's okay to recognize those retainers on a monthly basis over time. And there have been firms that have been able to demonstrate that. There have been firms that have not been able to demonstrate that. We've had firms, for the most part, not be able to demonstrate why they could recognize a retainer upfront when they sign an engagement agreement. There have been very limited circumstances where we have not objected. However, for the most part, we have not seen firms be able to document that analysis to show that. And then we've seen firms that don't recognize those retainers as revenue until the end of the deal, or close to when the success fee is going to be, which I believe that's consistent with some AICPA industry guidance that's out there on M&A accounting. I believe it's the AICPA revenue recognition guide. So hopefully that answers that question. Some of these others I'll keep to the end because I believe they are a little bit more general. So I'll keep trucking along here. So revenue recognition guidance. Oh, I'm sorry, not regulatory guidance, excuse me. I really want to talk about accounting still and revenue recognition apparently. So I have a couple of reg notices here that speak to T+1. T+1, for those not as close to it or not as familiar, about a week and a half ago, you know, the whole securities world went from T+2 to T+1 on a regular way basis. I can tell you that these reg notices 2404 and 2315, that the Cliff Notes version of those is that any rules that we had in our FINRA rulebook that referred to T+2, we changed it to T+1. Right. So obviously it gets a little bit more detailed than that, but that's kind of the gist of it, is that we had to update our rule book for that and let our membership know about it. Probably the more obvious question in your mind is, were there any issues when T+1 finally went live? And I could tell you that similar to Y2K, for those that remember that, not so much. So it was pretty quiet. Actually, there was a meeting Memorial Day weekend that was scheduled with a major trade group in the SEC and ourselves that got canceled because there was nothing to talk about. So it went that well, actually, at the end of the day. You know, a little bit of an uptick in fails, a little bit of an uptick in like extensions of time for margin, to collect margin from customers. But things that turned around very quickly and were not long dated fails or long dated extensions or anything like that. So thankfully has gone pretty smoothly so far. Reg notice 2321, you already heard my song and dance on that, so I will relinquish there. Information notice from back in November, we give you the cheat sheet there for all the due dates for all the different types of filings that you have, including the annual reports. If you're an off-cycle, non-calendar year firm, broker-dealer firm, then you know, you can go look at the report without having to try to calculate that. We go through the pain of doing that. Reg notice 2314. So I know that who has clients here that deal in covered agency transactions? So TBAs, CMOs, specified pool transactions. Pretty much what I expected. So I won't spend too much time on this one, but you can know that there was a long time coming rule on this that was requiring that margin be collected on these types of transactions. For a long time, it was not required. It is now. There's a whole process around it. If you go to the FINRA website, there's a key topic page on it under margin regulation. For firms where maybe it's an introducing firm and they may be in this business and they have a clearing firm that they clear through, but they're involved in this business, I would just take a look at this, because we've seen some introducing firms get tripped up on this, because in some scenarios, introducing firms had actually had to collect the margin from customers. So then they're holding customer cash. So that could have exemption reporting implications. So the main reason I mention this is really more for awareness. If you have a client or you have a firm that, even though they're fully disclosed and are in this type of business, just maybe understand the process a little bit to make sure they're not holding customer cash at any one point in time. All right, liquidity risk management. This is another one that most of you are not going to be too excited about, because it really has mostly to do with carrying firms. But what I will give you is kind of a high level FINRA cares about risk management, no matter what size of the firm, right? But we have a risk-based approach to everything. We have a risk monitoring program. We have a risk-based examination program, right? So, and most of our business, or most of our industry, is ultimately going through clearing brokers, even if they're coming through introducing brokers as well. Liquidity risk management has been something that has been a focus of ours. I would say for probably 25 years. It became more prevalent around the financial crisis. There were some reg notices we put out, most prominently 2015, 1533, where we did a study of firms, large and small, and their liquidity risk management practices. I was one of the smaller firms that they looked at. Well, they looked at my firm right before I had joined them. Didn't go too well, by the way. That's probably one of the reasons I joined them. So I have some interesting background on that if anyone's interested in hearing about that later. But when you hear liquidity, I would say the main thing to keep in mind here is there isn't a specific rule, in the FINRA rule book for liquidity risk management. The SEC doesn't have one either, except for the fact that if you have a program, you should document it, is really what one of their rules say. And that's for larger firms. But there isn't a specific liquidity risk management rule. For those of you that are familiar with banks, when you hear liquidity, you hear Basel III, you hear those buzz terms. You hear liquidity get mixed with capital a lot, right? In terms of net stable funding, there's ratios, you have to keep a certain amount of capital on hand to do business. We're looking to develop a rule that is more really about risk management and really what would cause a firm to go out of business. Frankly, almost overnight. So when I think about net capital, I think about the rule. Obviously, it's been long-standing for decades, right? SEC rule, critically important, but it is focused on making sure that you have enough liquid assets to meet your obligations to customers and counterparties and other stakeholders in the event of a liquidation, right? If you actually have to get liquidated and go out of business. I think of liquidity as you want to have enough liquid assets on an ongoing basis so you stay in business and you never get to that point, right? So that's really what this is designed for. We went out with what's called a concept release to the industry and soliciting feedback. So there's a technical reason for that. So we went from staff working on this rule to straight to concept release, because we wanted to get feedback, because this isn't a common thing to go out and do from a regulator perspective. It's a very complicated rule to try to do, and there isn't one that's very similar to this and as detailed as we are attempting to do it. So we wanted to make sure we were getting industry feedback on it to make sure we're on the right track. And so we didn't go, typically the process would be we would have to go to our board of governors, get it approved, go out with a reg notice to members, get comments, come back, do a filing with the SEC, get comments, and then hopefully it would get approved. We haven't even started that process yet. This isn't even a rule proposal, it's a concept release. But it's something that we've been taking the feedback very seriously on this. We read every comment letter. Similar to, I know some of the PCAOB staff had mentioned earlier, looking at every letter, whether it's short, long, data, no data, we look at everything multiple times and we try to factor everything in. So this is something that I would hope that we would have more public communication on this year, where hopefully we are proposing a rule. Obviously, we can't control the whole process, and especially given the time of year. But most of the comments we got were not really showstoppers. It was mostly, hey, consider the fact that I'm part of a group that also has banking regulation. There may be some overlap, or it may be too much of a burden, things like that. And those are things that we obviously do take that very seriously. So last reg notice I have on here is related to customer statement amendments. So again, I'll be really brief on this one. Way back when, before there was FINRA, there was the NASD and there was the NYSE, and they eventually got merged. But before they got merged, they each had their own rule book, and they had their own rules around customer statements. So now they get merged, roughly 15 years ago or so. I think a little bit more than that now, actually. And the rules were slightly different. And just the way it came over technically was that the NASD rule basically became the FINRA rule. And then there was this like, hey, we have this kind of rule book on the side a little bit for the firms that are still registered with NYSE or the New York Stock Exchange. You still have to apply those as they came over. This is just a long time coming of them combining it. There were some things that were different that I think the NYSE rule was requiring in terms of like summary statements and things like that. That'll now be required going forward. Why this is important, if you have any firms that are filing a compliance report, which I know most of you don't, but just as an awareness, this rule is applicable starting January 1st of this year, 2024. So if you're testing controls over compliance, it has to be for the whole year, obviously, right? So you have to make sure you're in compliance with the new rule and not the way the rule was last year. All right, exemption reporting. This should hit home, I think, a little bit better, right? Whose firm's clients file exemption reports? Nobody? Yes, I see yeses. Okay, yes, thank you. So 95% of our firms file an exemption report, right? So 3,400 firms, so 95% of that, right? So roughly 3,000 firms that file an exemption report. So essentially, that report is saying, hey, I'm paraphrasing, obviously, we don't handle customer funds and securities. We're not a clearing carrying firm. This is our basis for why we think we should file an exemption report. These were the exceptions we had, right? All that 95% of firms that file an exemption report, about 70% of them are retail firms, which kind of makes sense, right? The main exception that comes up or issue that gets reported is related to the prompt transmittal of funds or checks. So we have firms that say, we didn't promptly transmit by noon the next business day once, 3 times, 3,100 times. Yes, we've had firms that said 3,100 times. Obviously, that may be a flag for there's a process issue, right? So you apply a little common sense there. But we're users of the report, right? So that's regulatory intelligence for us, and we're going to look at that closely. But that's for the most part kind of the gist of exemption reports. Where we spend most of our time, frankly, is what is the basis that firms are providing for filing the exemption report, right? So as many of you, I'm sure, are familiar, is 15C 33K. There's the K1 exemption, K2I, K2II. So there's a set of FAQs out there. So there's a link here. The first link I think is pretty useful. It's been out there it hasn't changed in a few years now, but it provides some pretty good information. Really, those 3 links I have there on top are good. The first one I think is the most substantive, but it talks about how you can claim more than one exemption. So you can be K2I and K2II. It also talks about this footnote 74 concept, which I'm sure a lot of your firms have as well. So when the SEC, when the broker-dealer financial reporting rules were updated back in 2013, there was literally a footnote 74 in the release, and it said that, hey, if you don't fall under one or more exemptions, under 33K, but you did not hold customer funds or securities during the year, you should still file an exemption report. It's basically one sentence that just says that, right? So then there's questions, what does that mean? How do you apply that? So in the FAQs, it does reiterate that, and it gives some examples of businesses that would be footnote 74 businesses. So a few tips on this. One, your business does not have to be one of the ones listed in that FAQ to claim footnote 74. If that business line was not holding customer funds or securities during the year by design, how it's been designed and processed, then it's a footnote 74 activity, whether it's named in that FAQ or not. That's not meant to be an exclusive list in that FAQ. So for those that are familiar, and if you're not, I think it's FAQ 8, you can take a look at that. That's an important point. So I mentioned that the FAQs talk about a firm that has multiple exemptions, a firm that's footnote 74. Well, what if you have both? FAQ doesn't talk about that, right? But we have plenty of those firms. We have firms that they fully disclose the business to a clearing firm under K2II, but they also do an M&A advisory business, or they also do proprietary trading. M&A and proprietary trading, depending on how, I like to say how the plumbing is set up, but 99.9% of the time, you're not handling funds and securities. Those are footnote 74 type activities. So we call those like mixed firms or mixed business firms. You'll hear maybe hybrid firms. Our expectation is that if an exemption applies to you, you claim that in the report. If you also have activities that would fall under footnote 74, you disclose those as well. If you need to know how to go about that, the AICPA, another one of those Google things you're going to do, right? So AICPA exemption report template, they have 4 scenarios listed there. One with, I have an exemption. One with, I have multiple exemptions. Another one, hey, I'm footnote 74. Another one, I have all of the above. And it gives you the wording of how that works. It's industry guidance. It's provided by a trade group. I can tell you that us at FINRA and the SEC trading market staff did look at that before it was published. So it does incorporate some of our comments and things that we thought should be in there. And I could tell you that the consistency of reporting in a positive way has improved dramatically since they put that out a few years ago. So I would definitely take a look at that. I think it'll make a lot of the lives of a lot of folks a lot easier by following those templates. A couple of side items. Just want to make sure I'm doing okay on time. What, about 10 minutes, roughly? So one thing that comes up, my membership agreement says K2I. Do I put that, but I'm not doing that business. Do I claim that on the exemption report? And what I'll tell you is the membership agreement and the exemption report are 2 different things, 2 different rules. The membership agreement, I think of as more of a static type of report or agreement, in that a firm goes in, they're looking to be registered as a broker-dealer, and you may get approved for 5 business lines, right? You could do these 5 businesses, okay. But in reality, you only do 2 once you get active, right? Now, the exemption report it's new every year. It's for every fiscal year, and it depends on what your actual business activities were during that year, right? So you could have that you know 5, 6, 7 things listed in your membership agreement. You wouldn't list 5, 6, 7 things in your exemption report if you're not doing them. So they don't have to match 1 for 1. Now, with that said, because we always get this question, if I say on my exemption report that I am introducing a business, I am fully disclosing a business to a clearing firm, K2II, but I never got approved to do that to begin with, that's a problem, right? You're doing a business you have not been approved to do yet. You should probably speak to someone at FINRA about that and get that fixed, right? Or maybe just don't do that business since it wasn't approved. But that's a different issue. That's not an exemption report issue. The exemption report's right because you're actually doing it, but you have an issue with a different rule set, right? But those reports don't need to match each other. So you can, even if your membership agreement says nothing about footnote 74, you can still, if it applies, put footnote 74 in your exemption report. We've gotten a lot of questions about that. There are firms that want to put footnote 74 reference into their membership agreement anyway, at the urging of their auditor. That's just what I heard. I'm not pointing any fingers, right? That's fine. We'll do that. We won't charge the firm to do that. We've said that publicly. We're not requiring that, but they can do that if they want to. So that's something else to keep in mind. For anyone that has clients that are K1 firms, what I'll say is important about K1 is it's an exclusive exemption. You can only do the business that is described in K1, and it's related to like mutual funds and insurance type products, broking and dealing, those types of products. A lot of firms I find they do that, and within the same process, they also offer 529 plans. 529s are municipal securities. K1 is a very product specific exemption. If you do 529 plans, you can't claim K1. Now, why? So K1, from my understanding, it was designed very closely to be aligned with being exempt from being a SIPC member. So if you look at the exemption from being a SIPC member and you look at K1, they're not exact, but they're similar. So if someone's claiming K1, my next question usually is, well, are they a SIPC member? Because obviously that's a big deal, right? Whether a SIPC member or not, you want to make sure customers are protected. If they are a SIPC member, but they claim K1, well, it's probably an administrative issue. Let's just have them fix it going forward, right? If they're claiming it and they shouldn't be because they're doing other businesses or they don't meet the exemption and they're not a civic member, that's a longer conversation, right? So that's something to just be sensitized to as well. Just to round off this point, and I know this whole slide's about exemption reports, but for the compliance report for the 5% and the 0% in this room, the one thing I'll point out is that for the reports that we got for 2023, and again, that's only 5% of our firms, so usually our larger firms, 13% of them reported material weaknesses, which I think is relatively high. I would say the top item that comes up is related to controls around customer statements, so that's about a third. The next third is related to the customer reserve computation, coding, data integrity issues, things like that. And the last third is kind of a mix of net capital, possession or control, security count, but that mostly has to do with IT controls around data integrity is what we're seeing come in terms of those reports. So CPE code 520. All right. So that code was 520. So in terms of observations, so I definitely would recommend folks to look at the 2024 regulatory oversight report. It's pretty comprehensive. If you looked at it last year and you look at the one this year, they actually put in bold anything that changed. So it's pretty easy to reconcile. So you don't have to read the whole report again if you don't want to. You can just look at what changed and just look at the bold, which I find is very useful. But there's a lot of really good information in there. They added a whole section on crypto assets and what we're doing in that space. I won't get into too much on that. I think we probably beat that one up already. But before I get into maybe some of the things that touch the report, one thing that I think I always think is interesting and it probably does impact a lot of your firms is there's a Reg Notice 2105 that talks about an SEC order that provided an automatic 30-day extension for annual reports if you're a small broker-dealer, right? So what's a small broker-dealer? You have to be net capital compliant at your fiscal year end, have less than 50 million in capital. You have to be an exemption report filer, and you have to file electronically with the SEC, right? Those are kind of the points you have to hit to get this automatic 30-day extension. You have to make a notification to FINRA that you're going to do that. So it's not an approval, it's a notification. So the firm is making that attestation, the broker-dealer firm, that they meet those points. So 90% of our firms actually qualify for that, but only 50% of them actually elect to do it. So literally, line down the middle of who likes it and who doesn't, frankly. And I'm, in some of the conferences I've been to, I find that the FinOps have one reason for why they like it or don't like it. The auditors have another reason for why they like it or don't like it. But it's definitely mixed, to be quite frank. So I feel like that's always an interesting statistic. It has ticked up a little bit in the last 2 years, but it hasn't been anything over 45% before this. I think 45 or 46%. So it's literally down the middle right now, which is interesting. Let's see. So let me pause there. Just look at some questions that we have here. We got a question about, has the spike in enforcement matters led to an increase in firm deregistrations? I think if you look at public data, and I don't know if this is necessarily driven by enforcement actions, to be honest with you. I think there's various reasons why broker-dealers get out of the business. The number of broker-dealers have definitely declined over time. There's no doubt about that. I think that the rate seems to have slowed down a little bit, but there's kind of an offset. We have a lot of firms that are coming in and asking to do crypto asset type activity, and then there'll be other firms that are coming out, right? So there's kind of this net off a little bit. But there has been a decline. I don't know necessarily if it has to do with enforcement matters directly. I mean, I'm sure some do, where we obviously have firms that get expelled or suspended, or that get referred to the SEC to be expelled. But beyond that, I wouldn't say there's anything specific related to that. This one I'll leave to the PCOB staff. Right. He teams the industry expressing concern shortening. Let's see. No, I think that's mostly it in terms of the questions. CPE code 244. 244. And I will leave you with the FAQ key topic page. There's some good topics on here that have some good information, including the annual reports. I would definitely take a look at that. And if you have any other questions, I will be here until the end. So you could, I think we're on break now for 10 minutes or so, or even towards the end. Let me know. I'm sitting in the back corner over there. Okay. Thank you very much.